Hi there, welcome to my channel. In this video, we are coming to look at the bank reconciliation statement and how to prepare one in Microsoft Excel. Alright, so we are going to dive into the concept of bank reconciliation statements in accounting and how to prepare a bank reconciliation statement in Microsoft Excel. So, you might have come across bank reconciliations, if you are into accounting or you are in a business related field, you might have come across the term or the concept of bank reconciliation statements. It is a very popular and very useful accounting knowledge to have because, believe you me, every accounting person you know does one form of a bank reconciliation or another. All right. Even if you are not able to do a bank reconciliation itself, you should be able to translate this knowledge into performing other forms of reconciliations. All right. So in this particular video, I'm going to begin from scratch. So if you are already familiar with the concept of bank reconciliation, you are free to skip the beginning parts of the video, but as much as possible I would advise that you stick to every part of the video because I'm going to share useful tips and information that is going to help you solidify whatever knowledge you have about bank reconciliation. All right, so what is the bank reconciliation and why is it so important in accounting? All right, so in every business, the business, what it does is that it has a bank account. All right, there are actually laws regarding the holding of physical cash. Okay, so a business is not typically allowed to hold cash to a certain minimum, and that is for economic reasons. All right, so that is the reason why businesses usually have business accounts. But what usually happens is that they also have an account in the books that is called the bank account. All right, and it is normally part of the cash book of the business. All right, so what happens is that whatever transaction that is being undertaken through the bank will also be recorded by the business or the accountant or the bookkeeper in the books of accounts, so that at the end of the period, usually 1 month, what happens is that they will go to the bank and take a statement called the bank statement and present that statement to the bookkeeper or the person who prepared the cash book for reconciliation to be done. That means that usually at the end of the month, the transactions that are recorded on the face of the bank statement do not usually tally or agree with those recorded in the books or in the cash book. All right, and you are talking about the bank column of the cash book. Now let me show you how the cash book looks like. So this is a typical format of the cash book. All right, so you have a date column, you have a description, you usually have ledger folio. All right, you might also have an ID, transaction ID column, something like that, but those are not really important to our discussion, so I've left those ones out. So we have cash, bank, discounts. All right, so this is a typical format of a 3-column cash book. All right, the 3-column cash book, you has a discount column as well. So this is how the cash book looks like, and what you are saying is that when the bank receives when a customer, or which is the business, receives a bank statement from the bank, from its banker, is going to compare the transactions that are on the bank statement with those recorded on the cash book, and the balance of the bank column of the cash book, which is usually down here, will be checked against the balance on the bank statement. Now this is the format of the bank statement. All right, I'll be explaining it in a moment. So this is the balance. This balance here will be checked against any balance brought down or carried down. Now if you want to learn how to prepare these accounts and balance of the account and know how to balance off an account, then you can check out my video on how to automate accounting ledgers and also extract the trial balance. All right, I've explained all of that in in that video. So this is what happens, that when after comparing the balances, usually they do not agree. So what happens is that bank reconciliation allows the accountant or the bookkeeper to reconcile the balances. All right, so in this case, the balance of the bank statement and the balance of the bank column in the cash book. That is what happens. So that is what reconciliation is all about. So bank reconciliation is prepared, all right, by a current account holder usually, in order to bring the balance of the cash book, which is the bank column here, into agreement with the bank statement balance, which is this balance here. I'm going to explain the bank statement in a moment. All right, so usually what you are saying is that the two balances, the balance of the bank statement and the balance of the cash book, which is the bank column, do not usually agree. So there is the need for us to make them agree, and we use the function of the bank reconciliation statement to achieve that. All right, so that is what the bank reconciliation statement does. All right, now the bank reconciliation statement, as I said, does not only help you to reconcile the two figures, but also it will help you to identify transactions, the individual transactions that are appearing on the two accounts. All right, so you are talking about the bank statement as well as the cash book, and then you can be able to reconcile the individual transactions as well. All right, so that is just a brief introduction to what bank reconciliation is all about, and that is why it is very important in accounting. Every business keeps their cash book. All right, there's a cash book for every business, and every business owns a bank account. At any point in time, usually at the end of the month, there is the need for the balance of the bank statement and the balance of the cash book, which is the bank column, need to be assessed and reconciled if there is any difference. All right, so that is what bank reconciliations do. All right, so we have been talking about differences. So what is causing these differences between the bank statement balance and the cash book balance? What are some of the reasons for the difference between the two balances? And I've listed some of them here, the very important and common ones. So let's look at them and see what we have here. So the first one I've listed here is what we call unpresented checks. All right, one of the reasons why there is a difference between the bank statement balance and the bank column of the cash book balance is what we call unpresented checks. Now, what are unpresented checks? These are checks issued to creditors or suppliers. All right, so they are issued to creditors or suppliers by the customer of the bank, in this case the business, but have not been presented to the bank for payment. All right, so this is what I want you to get me very clearly on the explanations, because the reconciliation is all centered on the reasons for the differences. All right, so I want you to get it once and for all, so that when we get into the calculation, into the practice, you will be able to follow along. So this is what unpresented checks mean. These checks are presented to suppliers, which means you are using the checks, you have issued checks, and we want to pay our suppliers. All right, we want to pay our suppliers by issuing check. We have issued the check. This is the business issuing the check. Therefore, it has recorded it under the credit column of the cash book. All right, it has recorded it under the credit column of the cash book here, the credit side of the cash book. And the supplier is yet to present the check to the bank for payment. Now, let me explain the bank statement before we continue. So this is the bank statement. It also has a date, it has description column, it has debit column, it has credit column, and it has a balance column. All right, and then you have a credit. These credits attached to the balances here. There are times you can see what we call OD. So if you don't see credit, you will see OD. The OD means overdraft. All right, and that means that you have overdrawn your account. You have withdrew more than you have in your account. Therefore, the amount you are having, if it is attached with this OD, means that it is a liability in the account. It is a borrowed money from the bank. All right, and it usually attracts interest. So overdrafts are actually short-term sources of finance for businesses from their bankers. All right, so that is the OD. But in this case, we are going to consider the credit, which is usually the common phenomenon you will see. All right, so that's just by the way. So you have this. Now, what happens is that this is the balance from the previous month. This bank statement is for the month of June, as you can see here, 2023. So this balance is from May. All right, at the end of May, this is the balance we had, $500. And then on 2nd June, we deposited cash of $300. And whenever there is a lodgement or deposit or a receipt into your bank account, it is credited. Whenever there is a payment out of the bank, all right, whenever there is a payment out of your bank account, it is debited. All right, so that's the difference. Whenever there is a transfer into your bank account or a receipt into your bank account, it is credited, whilst all payments from your bank account are debited. So you should know that. So we have deposited this cash and it has been credited. Therefore, it has increased our balance to 500. As you can see there, 800. So 500 plus 300 will give us 800 here. Then we have issued some checks. All right, there are check numbers here, and since they have been issued, it means they were payments. All right, so $400, and that reduced our balance from 800 to 400 here. And we further issued another $100 check, and that reduced our balance further to 300. All right, then there is a credit transfer. The name is credit transfer. Later I'll explain what credit transfer means. You have received a credit transfer of $1,000, and since it's a credit, it has been credited to our bank account, and that has increased our balance to 1,300. That means that we have added it to the balance existing 300 to make it 1,300. Then there is a standing order of 200 that has reduced the balance to 1,100, and down to the last item here. Sorry, the last one here is bank charges. All right, bank charges of $100, and that has reduced the balance from 900 to 800. So this 800 here is the month end balance of our bank account. All right, shown on the bank statement right here. So that is what we have there. Okay, so this is the bank statement. Now what we are saying is that unpresented checks are checks that have been credited in the company's cash book as payment to suppliers, but have not been presented to the bank for payment, and that means that they have not been debited yet. Okay, since they are payments, they have not been debited, so you should understand that. All right, so that is what unpresented checks are. They are checks issued to suppliers for payments but have not been presented to the bank for payments. All right, okay, so that is it for unpresented checks. The opposite is uncredited checks. Uncredited checks. Now, these are checks which should have been credited to the business's account. Okay, if you're talking about the bank account by the bank, but it's not yet credited. So they should have been credited. Unpresented checks should have been debited, but they have not been debited. Uncredited checks should have been credited, but they have not been credited. And uncredited checks should have been credited here. That means that they should have been debited in the bank account. Okay, so they should have been debited in the bank account right here. But they have been debited here, all right, but they have not been credited in the bank statements. So that is uncredited checks. Okay, so they are deposited into the bank account, but they have not yet been recorded. That is the uncredited checks. They have been deposited, all right, but they have not been recorded on the bank statement. So that is an uncredited check. So that is that one. Then the third reason why there is always a difference between the bank statement balance and the cash book bank column balance is what we call omissions. So omissions can come in different forms. The first one is standing orders. Standing order. Now, what's a standing order? A standing order is simply a written instruction to the bank by a customer, that is the business, to pay at regular intervals a specific amount on behalf of the firm. Now, when this amount is usually paid by the bank, the customer might not be aware, all right, of such payments from the bank, and therefore will be omitted from the cash book. All right. Now, this is a standing order. A standing order is just like you having a bank account, and then you have instructed your bank account that at the end of every month or on the 15th of every month, deduct $300 in payment for my electricity bills, all right, or my water bills, or some other utility bill. All right, so that's a standing order. So at the end of or at that particular date, the bank will just effect that payment out of your bank account. All right, so that is what we call the standing order. And as you can see in the example here, the standing order is debited because it's a payment out of your bank account. And since it's debited here, in our cash book, it's supposed to be credited. All right, so it will be debited in the bank statement, but not on the cash book. So it means that our cash book balance will not agree with the bank statement balance. All right, the next omission, as you can see here, is dividends received. Now, dividends are usually received through the bank directly. So whenever you receive dividends, you own shares in a company, or you buy any form of you've made any form of investment, and there's a dividend on that investment. Such dividend will be paid directly into your bank account, and you might not necessarily be aware of such payments into your bank account, and therefore you may fail to record it as a debit in your cash book. All right, now dividend received is an income, so it means that it will be credited in your bank statement as an income, as a receipt, and it will be debited because it's an income. It will increase your cash position, all right, which is the bank column here. So it will be debited here as well. All right, so that is it for dividends received. And since that is happening, it will appear in the bank statement but not in the cash book, hence causing a difference between the two balances. The next one is bank charges. All right, so this is the regular charges banks charge from accounts. All right, and these are usually debited in the bank statement and so should be credited in the cash book. But if bank charges are deducted, the customer might not necessarily be aware of such deductions, all right, until upon receipt of the bank statement. Now, these are actually not common these days because of automation and because every transaction that occurs in your bank account is directly reflected on your phone, okay, on your mobile phone. Therefore, nowadays it is no longer an issue like that, but you might receive such text and may forget to enter the transaction on your cash book, and that might cause a difference. All right, so bank reconciliation statements are still relevant even up to today. All right, the next one is credit transfer. Now you have got to credit transfer. So a credit transfer is an amount paid by a firm's customer directly into the bank account, and this may be unknown to the business. All right, so a customer owes you and decides to pay you directly into your bank account. You might not be aware of such transaction, and therefore you may fail to enter it into your cash book, that is at the debit side of the cash book, because a credit transfer is an income. All right, as you can see from here, it's an income. All right, so that may also cause a difference between the bank statement balance and the cash book balance. The next one is dishonored checks. Now, dishonored checks are checks that have been refused for payment by the bank. Okay, it's one of the very common reasons why there's a difference between the bank statement balance and the cash book balance. Okay, so what are dishonored checks? As I said, they are checks that have been refused for payment by the bank. Now, usually there are reasons for checks being dishonored. All right, this is a stale check, that is, it becomes out of date after it has been drawn. The signature on the check is incorrect or does not match that of the customer's signature. Okay, the amounts written in words that not agree with the one in figures and all that. Those are some of the reasons why a check may be dishonored. All right, so what is happening here is that the business has drawn a check, all right, as a payment to a supplier once again, and it has entered it as a credit entry in the cash book, all right, because it's a payment to the supplier. The supplier then goes to present the check to the bank, and the bank disagrees or fails to honor the check. All right, so that means that our balance here will be reducing by the amount you have entered, but the bank statement balance will remain intact. It will be unchanged because the check has not been infected. All right, so that is another reason why there is a difference between the bank statement balance and the cash book balance. Then another form of omission is debit transfers. All right, just as we have credit transfer, that is payment to the payment to the supplier. All right, that is the debit transfer. So you might issue, it is similar to a standing order. Okay, so debit transfers, you are saying that your bank account has been debited, all right, in respect of some form of transaction. All right, it has been debited, but you are not aware of that transaction, and therefore you may fail to enter it at the credit column of your cash book. That will cause a difference. Another one is interest credited. All right, interest credited. So just as we have bank charges, your amount sitting in the bank account might attract interest, maybe at the end of um, a quarter, and such credit will be credited in your account, but you might not be aware, just as we have with bank charges, so that you can be able to enter it at the debit side of the cash book, and that will also cause another difference. So those are some of the omissions that we have. So you have identified three so far: unpresented checks, uncredited checks, omissions, and then the fourth one is errors. All right, errors. And with errors, we are talking about overstatements, understatements, transposition errors, and those are usually committed by the business, okay, in the cash book. All right. So, for instance, you want to write an amount of 858, and then you end up writing it 585. That is a transposition error, and that is also an undercast. All right. So, it will cause a difference between the bank statement balance and the cash book balance. Then a final one that I have here on my list is what you call wrong debit and wrong credit. All right. So that is usually committed by the bank. So you have lodged a cash amount of $300. The bank mistakenly enters it as a debit. That is a wrong debit. All right. You have issued a check for payment. The bank wrongly credits it rather. That is a wrong credit. And that will cause the balance of the bank statement not to agree with the balance of the cash book. So those are some of the reasons why there is always a difference between the bank statement balance and the cash book balance. All right. So now let's move on and go to the look at the sample of a bank reconciliation statement. Now this is how the bank reconciliation statement looks like. So you have bank reconciliation statement as at the date. So in case you are preparing a bank reconciliation statement for this particular um, bank statement, you might say bank reconciliation statement as at 30th June 2023. All right, so it's usually at the end of the month. So the last date of the month will come here and then the year follows. Right, so that is it. Then you have what we call balance as per adjusted cash book. Later on, I'll explain what the adjusted cash book is. Then after, when you start with, there are various ways of presenting the bank reconciliation statement. Okay, so you have to be very careful what you are starting the bank reconciliation statement with, what balance you are using to start it with. So when you start it with the balance as per the adjusted cash book, you have to add the unpresented checks. So right now, when I mention the term, you should be able to relate because you are familiar with the term. Okay, and then you are going to less uncredited checks. So you will have your balance as per the cash book, adjusted cash book or updated cash book, as some other books will put it, and then you will add unpresented checks. Then that will give you a total here, and then you less your uncredited checks from it, and that will give you your balance as per the bank statement. And this balance as per the bank statement should be equal to the balance, for instance, this particular balance here, 800. All right, that's what we are meaning there. Then alternatively, you can start with the balance as per the bank statement, balance as per the bank statement, which we have here. And then in that case, you are going to rather add uncredited checks. And then you are going to less unpresented checks. And that will give you your balance as per the updated cash book. All right. So that is how we present the bank statements, the bank reconciliation statements. All right. So those are the two most common ways of presenting it. Then we are mentioning adjusted cash book or updated cash book. What is the updated cash book and why is it necessary? We have the cash book, all right, and as we said, there are reasons why the cash book will not agree with the bank statement balance, and these are the reasons. So that means that there might be omissions within our our cash book, which needs to be included within the cash book to make us get the right balancing figure at the end of the period. Okay, so because of that, you need to adjust or update the cash book to include those missing items. What are some of those missing items? For instance, uncredited checks. They are appearing in the bank statement, but not in the cash book. What are those missing statements? For example, standing order. Standing orders always appear in the bank statement, but might not necessarily appear in the cash book. That has to be updated. Bank charges, dividends received, credit transfers, dishonored checks, all of these, debit transfers, errors, all of these need to be updated in the cash book so as to get a corrected balance for the cash book, with which we can do the bank reconciliation statement. All right, so that is why the adjusted cash book is very necessary. So when you look at it, you will see credit transfer here, dividend received here, interest credited here, and these are all at the debit side of the cash book. And these should be entered or should have been entered at the credit side of the bank statement. So let's go to the bank statement and see what we have there. So when you come to the bank statement here, you will see credit transfer at the credit side, you will see dividend received at the credit side, and then you also see a cash lodgement here at the credit side. So that is what you are saying. Credit transfers, dividend received, they are all at the credit side. And when you come here, it is appearing at the debit side. All right. So as I said, the debit and credit system of the books of accounts within the business is somewhat the opposite of what happens in the banking system. So whatever you debit in the cash book is actually credited in your bank account, and whatever you credit in your cash book, in your business's cash book, is actually debited in the bank account. All right. So that is the dynamics you should understand. So when you come here as well, you see bank charges, you see dishonored checks, standing orders, debit transfers, and errors. Now, all of these should be appearing on the debit side. They are appearing on the credit side of the cash book and therefore should be appearing on the credit side, on the debit side of the bank statement. So as you can see, these are checks. These are checks, and they could be um checks for payments. All right, and we know that whenever we make payments, the cash book needs to be credited. All right, and then we also have what we call the bank charges here. As you can see, it is at the debit side. trade credit. This trade credit here means we are paying a supplier. Okay, that's a payment there. That's a trade credit. We are paying our creditor or our supplier there. All right, and it's at the debit side, so it confirms that it's a payment. Standing order is at the debit side here, so it's a payment. All right, they should all appear at the credit side of the adjusted cash book. All right, now this is how the adjusted cash book works. All right, so let me reserve that for now. When we get to the calculation, I will show you exactly how the adjusted cash book works. Now, as I said, the bank statements or your books might have what we call overdrafts. So when you come to the adjusted cash book, we have balance brought down here, and then we also have another balance brought down here. The balance brought down at the debit side is the normal balance of the cash book. All right, a cash book is an asset, and so therefore should have a debit balance. So having the balance brought down here is a normal thing to occur within the cash book. But when you see the balance brought down at the credit side, that means that there has been an overdraft from the previous period. All right, and that has been brought down to the credit side here. So that is what we call the overdraft right here. And so when you have the balance brought down here, and at the end of the period, these balances are more than, or the total for this column is more than the total for the debit side, you will still have another balance carried down here, which will be brought down here again as an overdraft. But where this is more, the debit side total is more than the credit side total, then this balance carried down here will be brought down here into the next period as the normal balance we are seeing at the top here. All right, so that is it. Now, to understand whatever we have done, let us look at a practical example and see how we can perform the bank reconciliation statement in Microsoft Excel. So we have come to the very core of the video proper. So let's get started. Now, this illustration, I have carefully selected it. Now, when you are already familiar with, or you have written an exams, or you have studied bank reconciliation statements, you could see that the question usually comes in statement forms. Okay, so you will see the transactions being written in sentences. Now, what happens is that if you are not familiar with this particular format of the question and you meet it in the exam, you might be confused. All right, you might be confused. But when you understand this particular format of the question, when you get to the statement one, it will be easier for you. All right, that is the reason why I have picked this particular format for my example, because it will make you understand the concept of reconciliation better. All right, and that is what actually happens in practice. In practice, you will not see the transactions in a bank statement being written for you in sentences. Rather, they will be presented to you in a statement form as we are seeing here, and you also prepare your cash book in your ledgers. All right, in your ledgers, and that has to be reconciled with the bank statement balance. So this is more practical than the statement ones that we've been seeing in our books. All right, so that's the reason why I selected this. So let's get started. Now, this information is extracted from the cash book, that is the bank column, of Patch Hayes. All right, Patch Hayes for the month of April 2024. You are required to update the cash book up to 30th April 2024 and also prepare the bank reconciliation statement as at that date. All right, so that is what we have been asked to prepare. So you have to update the cash book, that is the adjusted cash book or the updated cash book, and also prepare the bank reconciliation statement as at that date. So this is the cash book presented to us. So we have the year here 2024, 1st April. So the cash book has been prepared for the month of April, and we have a balance here. We have some transactions related to some people here. So we have Y Palms, S Jones, Cash, and then A Owens. All right, and then when you come to the credit side, you have O SAR. We have a payment to C Keynes. We have a payment to M Raju, and then there is a balance carried down, and the balance has been brought down here as well. So, and then we also have she received the following bank statement from her banker for the month of April as well. So this is the bank statement. You have received the bank statement, and the bank statement is also showing a different balance of 13,560. Meanwhile, the cash book balance is showing $12,700. So there's a difference between the two balances. Ideally, this should be the same. All right. So that is what you're coming to do. Now, that is what we have for this particular question. Now, before we continue, I want to state that what happens is that this particular balance here, is not correct. Why? Because from our previous discussions, when we were discussing the reasons for the cash book not agreeing with the bank statement balance, we have identified that sometimes things may be entered in the bank statement, or transactions may be entered in the bank statement which will not appear in the cash book. Therefore, the cash book is missing certain items. All right. And so we need to update it. That is the reason for the updated cash book preparation. All right. So when you come here, I already have a format here. Remember, I'm going to leave the question together with the format in the video description so you can download it and follow along. All right. Right. So you have 12,000 here. It's 12,700 here, and this balance here is incorrect because some items might be missing within our cash book, and that is the reason why the balance is not agreeing with the bank statement balance here. So we need to correct, or we need to include those missing items within our adjusted cash book. So what happens is that, as I said, the debit side, so let me put here debit, all right, and then let me also put here credit. In accounting, we can shorten it CR and DR. DR representing debit and CR representing credit. So what happens is that what we do to identify the missing figures on each side of the cash book is that we are going to compare the side, one side of the cash book with the corresponding side in our bank statement, and compare the credit side of the cash book with the corresponding side in the bank statement to see what is appearing in the bank statement but not in the cash book. So whatever is appearing in the bank statement but not in the cash book is going to be appearing in the adjusted cash book. That means it's missing in our cash book. So this is what I mean. The first one we want to do here is we want to compare the debit side of the cash book, as I said, with the credit side of the bank statement, because those are the things that are moving together. Whatever increases our cash position is debited in our cash book, and the same will be credited in the bank statement because it is increasing our bank transaction as well. As I said, the cash book here is talking about the bank column only. Take note of that, the bank column only. Therefore, every transaction here is supposed to match what is in the bank statement. All right, so let's do the reconciliation and see. So I'm going to reduce this a little. All right, pardon me if you can't see well, but this is to enable us view the two statements, or the two and the cash book and then the bank statement at the same time. All right, so we have, this is the credit side. We are going to compare it with the debit side of the cash book and see what is appearing in the credit side of the bank statement but not at the debit side of the cash book. Whatever we see there which is missing in the cash book will be updated at the debit side of the adjusted cash book. So let's go. The first item here is a check received. So I said received because this is the credit side. So everything here is a receipt. All right. So we have received a check of so the check here is actually not there. Let me see. Since I've done something here. So we have received a check of 1520. All right, and from our cash book, we are getting to understand that the check is actually from Y pounds 1520. Therefore, this has correctly been entered in the cash book. Therefore, there is no problem with that. All right, let's move on to the second item here. So we are comparing the bank statement, the credit side of the bank statement, with the debit side of the cash book. The second one is 1080. We can see 1080 here, and we have received it from, it's a check we have received from S. Jones. And these people might be customers to the business. They might be customers to Patch Hayes. All right. So they are actually checks we are receiving from them in a settlement of their debts. All right, so we have 1080 there, you have 1080 here. We have $1760 cash received, $1760 cash received. All right, then that is all. Then we have 1040, an amount of 1040 here. That is credit transfer. All right, so that is credit transfer from Kate. $1040, but that is not appearing in our at the debit side of our cash book here. That means that it is missing from our cash book. Therefore, we need to include it in our adjusted cash book. That is the format. All right, so I'll just come here and write credit transfer. So we have credit transfer, and that is from Kate, and the amount is this 1040 here. All right, so that means that now the adjusted cash book. All right, so what we are supposed to do first, so let me cut this. This is not wrong, but we just jumped a step. So let me paste it at the second column rather there. So what we do is that because we are saying that the cash book here prepared is not including all the transactions that are appearing on the bank statements, this balance brought down here, all right, the cash book balance here is incorrect. Therefore, we need to adjust it for any missing items. Therefore, we need to restate this particular balance because the balance is incorrect. So we need to restate it so that we can adjust it for any missing items for us to get the corrected amount. And that is the amount or that's the balance you are going to use in preparing the bank reconciliation statement. So first of all, we need to bring the balance. All right, so I'll come here and write balance brought down. Sorry. So this is supposed to be slash. So balance BD, that's the balance brought down. Other books you see balance brought forward. It's the same thing. So I need to link up that particular value there. All right. So let me insert my border that has been cleaned there. Okay. So that is what we have. So I just brought the balance and then the credit transfer which has been missing. All right. So as I said, that is what has been missing on our cash book, so we have brought it as 1040. That's fine. So I think that is all for the credit transactions here. So just as we did with the debit side of the cash book together with the credit side of the bank statement, we are going to compare the debit side of the bank statement with the credit side of the cash book and see whatever is missing on the cash book will be entered in the adjusted cash book. All right, so that is what we are doing here. So I'll come here and the first one we are going to have is this 940 from OSAR. So we made a payment to OSAR of 940 and we can see it here, OSAR correctly recorded. All right, then we have another transaction here. There are actually only two, so that is it. We have bank charges here 800, but we can't see any 800 on the debit side, sorry, on the credit side of the cash book. That means that it is missing in our cash book. The bank charges here has not been captured in our cash book. Therefore, we need to credit it in the adjusted cash book. All right, so everything that needs to be debited in the cash book but has not been debited in the cash book will be debited to the adjusted cash book. Everything that is supposed to be credited in the cash book but has not been credited will be credited in the adjusted cash book. All right, so that is it. And we know how we get to know that it's not been recorded, and that is by comparing it with the corresponding columns within the bank statement. So whatever column we have here, debit against the credit against the debit here. All right, so that is it. So we have bank charges missing there, so I will come here and write bank charges, and the amount is equal to 800 here, so I'll input 800 right there. All right, so we have the 800 there. So I think that is all. So we need to balance off the cash book now to get a corrected balance that we are going to use to reconcile with the bank statement balance. So quickly, I'll have alt equals to sum the debit side together. That is 13,740. And the total, since this is lower, the total is going to be equal to this as well. And then I'll have my corrected balance now as balance carried down, and that will be equal to the total for the two sides minus the total here, which is only one item, but bank charges of 800. I'll enter that, and that is 12,940. So this 12,940 is the corrected balance of our cash book, which is going to be used to prepare the bank reconciliation statement. So I'll come here and link this up right there. So this 940 here is the corrected cash book balance, all right, or is the updated cash book balance. So having updated the cash book, we now have a corrected cash book balance against the balance of the bank statement here, and that's what we are going to reconcile. Okay, still there is a difference. So now we have corrected the errors of the cash book. Now we have to correct the errors of the bank statement, and that is done within the bank reconciliation statement. That is how it is done. So we have our balance as per adjusted cash book here, as we have previously seen in the format. So I'll come here and link that up. And then what you are doing is that we need to add unpresented checks. All right. So how do we identify unpresented checks? What we do is that, as I said, the unpresented checks are those checks that have been paid, entered at the at the credit side of the cash book, but have not been debited in the bank statement. So that means that to identify unpresented checks, we are going to check the credit side of the cash book. Remember, not the adjusted cash book, because this is already worked on. All right, this is where the errors are still existing. So we are going to use those in our reconciliation as well, and not the adjusted cash book. The adjusted cash book, we only need the balance, the corrected balance here, which we have already taken. All right, so we are going to compare the credit side of the cash book against the debits of the bank statements and see if an item is appearing on the cash book but not in the debit side, on the debit side of the bank statement, then that becomes an unpresented check. All right, any payment on the credit side of the cash book which does not appear on the debit side of the bank statement becomes an unpresented checks. So what is the first one here? We have 940. 940 is here from OSAR. On the 25th, we paid C. Keynes of $2,120, and when you come to the bank statement, it has not been debited here. Therefore, it becomes unpresented check. So the first unpresented check is C. Keynes. All right, so C. Keynes there, and since they are going to be, I'm not sure if they are going to be two or more. Let me put the amount here for now. So I'll just do my equals and link the amount here. And let's continue. The next one here is from we paid M. Raju $820, and I can't see $820 within my bank statement. All right, I can't see 820 within my bank statement, and therefore I can conclude that that is also an unpresented check. So I'll come here and write M Raju, and I'm going to link up that figure as well, 820. And that is all for the transactions at the credit side of my cash book. All right. So with the bank statement or the bank reconciliation statement, you state your balance as per the adjusted cash book, and then you add unpresented checks. Unpresented checks are those payments appearing on the credit side of the cash book, but not at the debit column of the bank statement. So those are what we have done here. So I can come here and add these two together. So I can do sum, and then I'm going to sum these two figures together and enter there. All right, and then I can do alt equals to sum the two items here as well, and that will give me 15880 there. All right, so that is it. And then we need to less uncredited checks. So as I said, this is the first format. All right, I'm going to present it in the two formats for you to understand what we mean by each of them. So the first one is that when you start with the adjusted cash book balance, you have to add unpresented checks and less uncredited checks. So what are the uncredited checks? The uncredited checks are those that are appearing on the debit side. They are those checks, all right, that are um, appearing on the debit side of the cash book, but not at the credit column of the bank statement. Those are uncredited checks. So just as we did with the credit side together with the debit column, we are going to do the same thing for the debit side of the cash book and the credit column of our bank statement, so that any item that is appearing here but not here is going to be regarded as an uncredited check. So let's come here. We have our balance here, which is 9,900. The balance is at the balance column, so that is not part. We have 1520 here. We have 1520 here, referring to Y Palms. We have S Jones. We have received an amount of 1080 from S Jones. The 1080 is here as a check. That's correct. We have cash of 1760. We have this 1760 here. Then we have A Owens of 2320, and that is not part of our bank statement here, so that becomes an uncredited check and is the last item on the debit side of our cash book. Therefore, it is the only uncredited check item we have there. So as you can see, I hope you get the process. All right, that's how we do it step by step, and then you're able to identify all the items we need to prepare our bank reconciliation statement. So this is appearing at the debit side of the cash book, the bank column, but not at the credit side of the bank statement. Therefore, it becomes an uncredited check. It has not been credited. All right, so I'll just come here and put here is I'm going to subtract it, so I'll put a minus there, and then I can link this up, and that gives me this. And then I can also come here and do alt equals and sum the two together, since they are positive and negative figures, so I can sum them together, and that gives me the balance as per the bank statement, which we can see that it has agreed with this particular balance. So let me check that. When you come here, I'll use F4 to repeat that. So as you can see, the balance is agreeing with the bank statement balance here. All right, they are agreeing with the bank statement balance there. So that is what we mean by bank reconciliation statements. All right, now quickly let's do the second format. So the second format is starting from the bank statement to the top. All right, so you are starting from the bottom to the top here. So that is what you are coming to do. So in that case, you are going to end up with the adjusted cash book balance rather than the adjusted or the balance as per the bank statement. So we're going to start with the balance as per the bank statement, which is this amount here. Then in this case, we are going to add uncredited checks. We are going to add uncredited checks. And the uncredited check, as we have already identified, is referring to, let's see, that is referring to only one person. From our cash book, we identify it as A Owens. So I can just come here, equals, and link this particular figure here actually. But this is not supposed to be a negative figure. So I can put a minus against it to turn it into a positive figure there. And that is going to give me a total here. So let me delete the excess space. Let me delete that and also delete another one. Okay, so let me input my bottom border there. Great. So I can add these together. So I have alt equals and add those together. And that is giving me the same 15880. And then we can less our unpresented checks. So we know our unpresented checks to be from C Keynes and M Raju. I can copy that across using Control D. And the amounts involved are these 2120. So I'm just copying the figures from what you have previously done. Alright. And then I can add those together. So I can have alt equals here and add these two together. And that will give me 2940. And since we are lessing it, I'll just come here and do 1580 minus 2940, and that will give me 12,940, which should agree with the adjusted cash book balance. So as you can see, they are agreeing here. Alright, so that is how to determine whether your bank reconciliation is working correctly or not. Alright, so that is how we prepare the bank reconciliation statement. And this is everything you need to know about the bank reconciliation statement. I'm just going to make some further comments here. Now, we identified one of the reasons for the differences between the bank statement balance and the cash book balance as wrong debits and wrong credits. Sometimes you will see wrong debits and wrong credits within the question you are solving, all right, or the scenario you are dealing with. And how to deal with that is that whenever there is a wrong debit, all right, whenever there is a wrong debit, what we do is that we treat it the same way we treat uncredited checks. Whenever there is a wrong credit, we treat it the same way we treat unpresented checks. So what that means is that if there is a wrong credit within your question, whenever you are adding unpresented checks, you need to add the wrong credit to the unpresented checks. Alright, so assuming there is a wrong credit here, we would have done it. You see wrong credit here, and then the amount will come here. Alright, and we will add it to this particular figure here before subtracting it. That's what I mean. Assuming there was a wrong debit, we will see the wrong debit right here under uncredited checks, and that would have been added to this particular amount before we finally add it to the balance as per the bank statement here before getting the 15880. Alright, so that is how we treat wrong debits and wrong credits. Alright, that is the first comment I want to make. And then secondly, sometimes the bank reconciliation statements can be prepared without necessarily preparing the adjusted cash book. And when that happens, the presentation of the bank reconciliation statement contains the adjustments that we need to do within our adjusted cash book. Alright, and this is what happens. For instance, using the first format. Okay, so I need to minimize this. So let me minimize this a bit. So what happens is that when using that particular format, That is, you don't want to prepare the adjusted cash book. That is fine. What you need to do is that whenever you are adding um, unpresented checks, so assuming you have add unpresented checks here, it's going to move with these balances. All right, so all of these credit balances under the adjusted cash book column will move with your addition of unpresented checks, whilst these balances are going to move with the uncredited checks here. All right, that is what we do when you don't want to prepare the adjusted cash book column. So for instance, let me just copy this. Let me just copy that and paste it here. And what I want to do is to cut this and paste it here, and also cut this, cut the balance there, and paste it here. So I just want to demonstrate that particular treatment I'm talking about to you. So let me delete this. All right, so this is what happens when you have uncredited checks. You are going to have all of these items under it. So you have everything here. So I'm going to copy that and paste it under, sorry, and paste it under add unpresented checks here. All right, then you also have all of these. Copy that, I'm going to copy this and paste it here as well. So that didn't work, but all of these items are going to appear under the uncredited checks here as well. Okay, so that is how you can present the bank reconciliation statement without necessarily preparing the adjusted column cash book. In that case, you are doing the adjustments right within your bank reconciliation statement. So that is an alternative way of presenting your bank reconciliation statement as well. All right. So I think has been a merge of cells here, which is interfering with my thing. So that is just by the way. All right, that is just by the way. So let me just delete these. And then a final comment also that I want to make is that when it comes to I can't talk and do this at the same time. So when it comes to overdrafts, all right, when it comes to overdrafts, the treatment of unpresented checks and uncredited checks also differ. So in case this balance as per the adjusted cash book is an overdraft, it's an OD, as I said previously, it's an OD, what happens is that you are going to reverse the entries. You will rather add uncredited checks and you will less unpresented checks. If the balance per the adjusted cash book is an overdraft, that is what you do. You add unpresented checks and less uncredited checks. The same way, if the balance as per the bank statement is an overdraft, the reverse will happen. You are going to add unpresented checks here and less uncredited checks here. All right, so that is what you need to know. All right, so with that said, we have covered everything you need to know about bank reconciliation statements. So after this video, you should be able to comfortably prepare any form of bank reconciliation that is being presented to you, both in practice and in an exam scenario. So thank you very much for your time in this particular video. I hope you learned a lot. Kindly subscribe to the channel if you haven't done so, and also